My name is Whitney Townsend, and I am a mortgage loan officer and branch manager at our Southside office. Buying a home can be overwhelming, but we know the process from start to finish, and we're here to guide you every step of the way. Thank you for submitting your questions ahead of time because we used your questions to craft this presentation. So make sure you have a notepad ready and a pen ready so that you can jot down the things that are most important to you. Let's get started. Meet our FCCU mortgage team. We have mortgage loan officers at each and every one of our branches. So no matter where you are located, you can go into any one of our branch locations and work with a mortgage loan officer. So step one of the home buying process, you need to figure out how much house you can afford. And to figure out how much house you can afford, you need to decide how much money that you have to allocate towards the down payment. Now, in a standard mortgage loan, you'll need 20% down, but there are so many amazing programs out there to help you get into your first home. You can put as little as 3 to 5% down depending on your eligibility. In addition to figuring out how much money you can put down as a down payment, you need to figure out how much monthly mortgage payment you can afford, because you need to decide if part of your monthly budget allocates for a monthly mortgage payment and if you'll feel comfortable paying that each and every month for a long period of time. So all of these numbers might seem like a lot. This is why it's so important to work with your mortgage loan officer, and they can help guide you to figure out how much house you can afford based on your income and your other debts. After meeting with your mortgage loan officer, they can give you a pre-approval letter. This is an incredibly important part of the process. By having a pre-approval letter and then working with your realtor, you can show the sellers that you are serious about buying a home. That when you find a home that you absolutely love and fits into your budget and you're ready to make that offer, you have a pre-approval letter in hand to submit with that offer, showing the sellers that you're serious about the purchase and you're ready to buy. One of the questions that was submitted was if you should consider buying a home when you're single, if you're engaged, or if you're married, and what a difference that makes as far as getting pre-approved. So you can choose to be the sole applicant on a mortgage application, even if you're married. This depends on the income of both parties, the debts of both parties, and the credit scores of each individual. This is why it's important to meet with your mortgage loan officer and decide together whether it's better to be the sole applicant on the mortgage or to apply together. Most importantly, your mortgage loan officer will look at 3 big factors: your credit score, your debt to income ratio, and the assets that you have on hand for that down payment and closing costs. Now, debt to income ratio, these are all the debts that are on your credit report divided by the income that you make each and every month. Now, it's really important that when you look at your credit report to know that those are the only debts that are going to be considered. So if you have a cell phone bill that is not on your credit report, that is not going to be considered a debt. Now, with your income, your gross monthly income is considered. So gross means before any taxes and deductions are taken out. That is the income that's used to determine your monthly mortgage eligibility. So let's go through each portion of the monthly mortgage payment one more time. Principal. This is the portion towards the principal loan balance that you're going to pay each and every month. Interest. Interest is the amount that you're going to pay each and every month based on the interest rate that you qualify for. Taxes. These are the property taxes based on the specific property that you're purchasing. So the portion in your monthly mortgage payment is 1/12 of the annual property tax bill. And then the final piece is insurance. There's 2 different things to consider with the insurance portion. You're required to have homeowner's insurance, also known as hazard insurance, on the property. So you're going to escrow 1/12 of the annual premium for your homeowner's insurance into your monthly mortgage payment. The other factor of insurance to consider is PMI, which we'll cover in greater detail later. PMI stands for private mortgage insurance. When you opt to put less than 20% down towards the purchase of a home, you're required to have private mortgage insurance. This premium will be allocated towards your monthly payment and included each and every month until you have enough equity that you don't need it anymore. So PITI, principal, interest, taxes, and insurance. This is what's going to be considered your monthly mortgage payment and what you need to be eligible for when buying a home. Principal and interest, those 2 things go together. And then taxes and insurance, those 2 things go together. Your taxes and insurance go into what's called an escrow account. So what is an escrow account? An escrow account is an account that's held on your behalf as part of your mortgage loan. Your escrow account has 2 things in it: your property taxes and your insurance. Now, your property taxes are due once per year, and it's a big lump sum of money that's due based on the value of your home. So your escrow account has 1/12 taken out of your monthly mortgage payment and placed in that escrow account so that when your property taxes come due, the money is there and ready to go. This is a benefit to you as the homeowner because then you don't have to wait and have that bill received at the end of the year and need to come up with the money to pay those property taxes. So escrowing for your property taxes is a really great benefit of a mortgage loan that includes an escrow account. The other thing in your escrow account is your insurance. So you're required to have homeowners insurance, also known as hazard insurance, which insures the value of your home, the exterior, the interior, in case of loss or damage. We will escrow 1/12 of your homeowner's insurance annual premium on your behalf. This is a great benefit to you as the homeowner, so that when the homeowner's insurance bill comes due, the money is already available in your escrow account and is automatically dispersed on your behalf. So now you've been pre-approved and you know what type of house and how much house you're looking for. Now it's time to reach out to a realtor and they can help connect you with the right home that fits your budget. So it's really important that when you're looking for a home that you discern what are your needs versus your wants. So you may have a large family and you might need a few bathrooms and a few bedrooms. So that might be something that you absolutely need to have in whatever home that you choose to buy. There might be some other things that are wants. Maybe proximity to a park, maybe some sort of fancy kitchen that you want, or you want a finished basement. These might be things that you really want in your ideal home, but they might not be something that you absolutely need. So it's really important that as you're working with your realtor, that you let them know the things that you absolutely have to have, and then the things that maybe you just want, but wouldn't be a no-go if they didn't have it. It's also really important that you know the difference between a seller's agent versus a buyer's agent. So a seller's agent works on behalf of the seller of the home versus a buyer's agent, which is going to work on behalf of you, the home buyer, in order to find the house and negotiate the selling price. So it's really important that you work with your realtor to find a home that fits your budget and is going to work and satisfy all the things that you need in a home. Now, you may look at a lot of different homes before you find the one that you really want, and that's completely okay. Spend time looking at a lot of different homes so that you can see how homes differ from one another, and you might even find some other things that you really want in your home that you didn't even know you wanted before you started looking at homes. Most importantly, find a realtor that you trust. You want to find somebody that you feel is on your side throughout the process, that you can be open and honest with, so that if you feel uncomfortable at any point along the way, you can reach out to either your mortgage loan officer or your realtor and let them know your concerns. Okay, so you found the home that you absolutely love and you're ready to make an offer. There's a lot of different things that come into place when placing the offer. For example, maybe the asking price of the home is $200,000. After visiting the home and maybe taking a walk around, you realize that there's some things that would need to be repaired. So you choose to offer $190,000 after speaking with your realtor based on the things that will need to be repaired. This is something that you can do when you place your offer. You don't necessarily have to make an offer for the asking price of the home. It's important to note that if you offer less than the asking price, the seller might come back with a counter offer asking you to increase your purchase price back up to their asking price. Now, when you place that offer to purchase, you'll draw it up with your realtor, and along with your offer to purchase, they will present your pre-approval letter that you've received from your mortgage loan officer. One of the things that you might want to consider when writing that offer to purchase is any inspections that you would like to have done. So if there is a basement and you want to have a radon test or a home inspection to make sure that there aren't any faulty wirings or a faulty roof, it's really important that you are honest with your realtor about what you want to have done prior to the purchase of the home. You can write in that you want an inspection done, but writing that into the offer means that it has to be completed prior to the purchase of the home. Then this brings us to counter offers. Like I said, you can offer less than the asking price for the home, but realize that there might be some countering back and forth between the buyer and the seller. And this is completely okay and normal as part of the home buying process. You might present an offer of $190,000 with a closing date 90 days out from the date of the offer. Maybe the seller would want $200,000 and they want to close in 45 days from the date of the offer. Just realize that this is part of buying a home. It's very much a negotiation. Now, if your top price that you're pre-approved for is $200,000 and the seller comes back with a counter offer of $205,000, it's really important that you first talk with your mortgage loan officer before accepting any offer over your pre-approval amount, so that you don't get an accepted offer for more than what you can afford. Oftentimes, a home buyer will write a letter to the seller. So this is a letter explaining who they are and what they loved most about their home. This is kind of a love letter to the seller, explaining who you are, your family, your desires about buying their home. And this makes the transaction a little bit more personal between you and the seller. This isn't something that's required. We're just seeing it a little bit more in the home buying space. So if you can't find a home that fits all your wants and needs, and you're thinking, maybe I want to build my own home, this is absolutely an option depending on your eligibility. This is definitely a conversation that you should have with your mortgage loan officer, as the process of buying land and building a home is much different than buying a home that's already built. First, you would have to have 20% down to buy a piece of land. Then you'll have to get pre-approved for a construction loan based on the specific blueprints and cost of construction of your dream home. This process is usually a lot longer than buying a home, and it's something that is a very multi-step process. So it's important that you really make sure that you have all your ducks in a row before you start that process of buying land and building a home. We're going to go through now the 10 things not to do when buying a home. Number 1, make sure that you don't change jobs or adjust your income in any way. If you've been pre-approved and you're actively searching for a home, we want to make sure that all of the details on that application remain the same until you have that accepted offer. Now, if you're working at the same employer and you get offered a promotion at that same employer, then this is a plus because your income is increasing and you're at the same employer. This is showing consistency. If you have an opportunity to change jobs within the same field, first talk with your mortgage loan officer to see how this would impact. Number 2, do not buy a new car, a used car, a motorcycle, a boat, an ATV, or anything like that. The reason for this is that your pre-approval is based on your debts at the time of application that are on your credit report. If you add a new debt, which will be a new debt on your credit report, this changes your pre-approval because now your debt-to-income ratio is different. The amount of debt that you have, if it increases with the purchase of a new vehicle, that then voids out your pre-approval because those numbers are no longer accurate. Number 3, do not open up any new lines of revolving debt. These are credit cards. Also make sure that you don't excessively use any of these credit cards and cause the amount of debt showing on them to increase. This is especially important after you get pre-approved because once again, your pre-approval is based on your credit score and your credit report at the time of application. Even one late payment on a credit card can change your eligibility. Number 4, make sure that you don't omit any debts or liabilities or lie about any of the information on your application. It's important that you're truthful from the start so that we can mitigate any potential risks before we get too far into the process. Number 5, make sure that you don't change banks or credit unions during the process. You're required to provide 2 months of bank statements as part of the pre-approval process. We use this as a foundation of understanding how much assets you have for those down payment and closing costs. It's really important that the amount of money that you have in your account stays consistent throughout the process without any large deposits that are unaccounted for. Number 6, make sure that you do not spend the money that you have set aside for the down payment and closing costs. This is especially important since this was disclosed on your application when you got pre-approved. Make sure that you have that account set aside and earmarked especially for your home purchase. Number 7, don't buy any furniture. This is important because many times when you buy furniture, they'll offer you credit for that purchase. Once again, this is reported to your credit report and would change your debt to income ratio. So don't buy any furniture after you've been pre-approved. Number 8, don't originate any inquiries on your credit report. Any inquiry between the time of pre-approval and closing would have to be explained to the mortgage loan underwriter. So it's very important that you don't apply for any new cards during the time that you've been pre-approved until the time that you close. Number 9, once again, it's so important that the amount of money in your account is documented. Don't make any large deposits into your account without a receipt explaining where that money came from. A hiccup that we often see in the home buying process is somebody sells something and then they deposit those funds from the sale into their account. If you don't have a purchase contract from the sale of that vehicle along with the check received from the buyer and a receipt, we cannot count that money. Let's say you need $1,000 in order to close on the house and we don't have documentation of where those $1,000 came from, they cannot be used as part of the purchase of the home. If you have any questions about this, you can always reach out to your mortgage loan officer for clarification. Finally, number 10, Do not co-sign on a loan for anybody. This can be especially hard if somebody asks you to co-sign because they really want to buy a new car. But if your dream is to buy a home, then say no to anyone who wants you to co-sign on a loan. Even if it is their loan, as co-signer, you are liable for that, so it becomes part of your credit. If it's on your credit report, that means we have to count it as part of your debt to income ratio. This could jeopardize the purchase of your new home. So just say no to co-signing. Up next is home appraisal versus home inspection. As I mentioned, one of the factors that you can add into your offer to purchase is to write in a home inspection. A home inspection is something that is optional for most home purchases, but it's a good idea to have one to make sure that there aren't any defects in the home that you're going to be purchasing. So this home inspection would make you aware of any faulty wiring, any issues with the roof, with the plumbing, or anything that you should be aware of that you can then talk to your realtor about. You would talk to your realtor and then they could present something back to the seller if it's a major repair that you would like to have remedied prior to the close of the home. For example, let's say that there is a tear in the siding. And so the home inspector lets you know that this tear could cause damage to the interior of the home. So then you talk to your realtor and you let them know that you'd really like the seller to repair this prior to close. They can then present this to the seller and the seller can choose to do that or choose not to prior to the close. These small repairs might just be something that after you purchase the home and you're living there that you want to repair on your own. So it's really important to determine how major the repair is and then decide if it's something that you want to negotiate with the seller or just something that you want to do on your own. Now, if the home inspection reveals a few things that aren't major repairs, this might not be something that you want to bring to the attention of the seller. The seller might choose to walk away if you bring up too many contingencies or ask for too many things to be repaired. A major part of the home buying process is the home appraisal. After you have an accepted offer, as your mortgage loan officer, we will order an appraisal for you. Now, this is one of the costs that's included in the closing costs of purchasing a home. The home appraiser visits the home and based on the interior of the home, the square footage, the features including bathrooms, bedrooms, they'll determine a value of the home. Now, it's especially important that the value that the appraiser determines is equal to or more than the purchase price. Now, let's say that you have a purchase price of $200,000 and the appraiser determines the home to be worth $195,000. This would be when your realtor goes back to the seller and explains that the appraised value is $195,000 and then tries to renegotiate the purchase price on your behalf. Now, that's not necessarily something that the seller will accept. So in the event that the appraisal comes in lower than the purchase price, this may mean that you choose to walk away from the home purchase. Here are some other expenses to expect when buying a home. First, when you present your offer to purchase to the seller, you may want to include earnest money along with that offer. Earnest money represents your good faith as the buyer that you intend to buy the home. Earnest money can really vary from $500 all the way up to $3,000 depending on the value of the home and how much you're offering. That earnest money that you present along with your offer to purchase can be a portion of your down payment at the time of closing. This is very important to keep in mind that if you choose to walk away from the purchase, that you will not receive that earnest money back. Another expense to consider prior to closing is the application fee. Some lending institutions require that you pay an application fee. Fort Community Credit Union does not. This is something to consider when choosing your mortgage lender. Another expense to consider prior to close is the inspection. If you choose to have a home inspection, this is not included as part of the closing costs and would have to be paid directly to the inspector at the time of the inspection. Another important expense to consider prior to close is your homeowner's insurance. You are required to pay the first annual premium of your homeowner's insurance prior to the closing. Now, you have a lot of different options when choosing your homeowner's insurance. We recommend that you shop around and see what different premium options are available to you. This is included in your monthly mortgage payment. So the higher the premium, that will result in a higher monthly mortgage payment. You're required to pay your first annual premium of your homeowner's insurance at least 1 week prior to closing and provide your mortgage loan officer with a receipt. Now, you will still pay 1/12 of that homeowner's insurance each and every month because homeowner's insurance is due upon renewal. So after you've been in the home for 12 months and that homeowner's insurance comes due, that homeowner's insurance will be in your escrow account ready to be paid. These are the expenses to expect at the time of closing. First and foremost are closing costs. These are expenses that are incurred on behalf of your mortgage loan officer in doing your mortgage loan. These include origination, the appraisal fee, the cost of a title report, recording fees, and flood inspection reports. All of these different expenses are included in one lump sum as part of your closing costs. When you're getting pre-approved, consider not only the down payment that you'll bring at the time of closing, but also the closing costs that will be due at the time of closing. Your closing costs are a one-time payment at the time of closing. Only your escrow account is part of your monthly principal, interest, taxes, and insurance payment. Now let's discuss loan types. There's two major types of loans that we'll be covering here. Fixed rate mortgages, which represent a fixed interest rate for the entire term of the loan, and then adjustable rate mortgages, where the interest rate is fixed for a beginning portion and then adjusts at a predetermined frequency throughout the term of the loan. For most home buyers, a fixed rate mortgage is the best option. The reason why is that a fixed rate mortgage provides predictability for you as you plan your monthly expenses. You can count on the same monthly mortgage payment throughout the entire term of the loan. Some buyers choose for an adjustable rate or ARM mortgage depending on their unique circumstance. For example, if a home buyer intends to only be in a home for a short amount of time, then an adjustable rate mortgage might make sense. These are really important conversations to have with your mortgage loan officer to determine what mortgage type is best for you. There are many different down payment options. As I mentioned, the standard down payment is 20%. However, there are many amazing options for first-time home buyers offering as little as 3 to 5% down. First, let's cover the Home Ready loan. Depending on your eligibility, meaning your income and your credit score, you might qualify for as little as a 3% down payment. The 3% down payment means 3% of the purchase price of the home. The Home Ready loan program is perfect for borrowers who are trying to get into their first home but maybe don't have a lot of available cash. The next type of loan is a conventional mortgage of as little as 5% down. Once again, your eligibility will depend on your credit score and your debt to income ratio. The next type of loan is a VA loan. Now, if you are a military veteran or you're an active military person, you may qualify for a VA loan which offers as little as 0% down. The next type of loan is an FHA loan. An FHA loan is as little as 3.5% down. It's best to determine whether a FHA or a Home Ready loan is best for you after speaking with your mortgage loan officer and determining the specifics of your application. It's important to remember that if you choose a loan program of anything less than 20% down, you're going to be required to have private mortgage insurance. PMI is an insurance that insures the mortgage lender against your default if you offer less than 20% down payment. This premium is going to be included in your monthly mortgage payment. If you have 20% down, then you can choose which loan program fits your needs the most. One of the benefits of having 20% down is that you're no longer required to have private mortgage insurance, which will decrease your monthly mortgage payment each month. A higher down payment will usually result in a lower monthly payment. This is important to consider when choosing how much home you can afford. So you might be asking yourself, how can I find the money for my down payment? One thing that I can say for sure is to save, save, save. If you know that being a homeowner is something that you want to do, then create a special account that you're going to save into each and every month and earmark that money for your home purchase. Now, in addition to saving, there's some terrific grant programs available within Jefferson County. Later, Casey will be sharing about these grant programs and the specific qualifications for them. One of the great things about putting 20% down on a mortgage, if you're able to, is that the principal balance will then be lower than if you only put 3 to 5% down. This means that the amount of interest that's accruing on the principal balance will be less over the term of the loan. If placing 20% down is an available option for you, that's fantastic. If it's not, that's fine too. We'll find a program that fits your needs and your unique circumstance. Next up is closing and moving in. This is the most exciting part of the process. Closing encompasses you and the seller coming together and signing the documents that will transfer ownership of the home from the seller to you. It's very important that you stay in communication with your mortgage loan officer and your realtor throughout the entire process so that the closing goes smoothly. One of the most important pieces along the mortgage loan process is communication. Like with any relationship, communication is key. From the time that you have your pre-approval until the time of close, it's important that you stay in communication with your mortgage loan officer and their processing team and are responsive to any requests for information along the timeline. For example, if we require additional bank statements, it's important that you respond to that request and provide printed bank statements from your bank account. Any information that is requested by your mortgage loan officer or your mortgage loan processor is important in the financing of your home. We wouldn't be asking for the information if it wasn't required from the underwriter. So 1 week prior to closing, it's important that you provide that receipt for 1 year's homeowner's insurance paid in full. We've prepared this really awesome closing checklist for you to have on hand to make sure that you follow each and every point on that checklist and make sure they're done prior to closing. Another thing to consider after you've closed on your home is what expenses to expect when owning a home. Owning a home results in additional expenses that you may not have as renters. For example, the energy bill for an entire home is usually going to be a lot higher than the energy bill for an apartment. Once you're a homeowner, it's important to realize that if anything goes wrong with your home, you're going to be responsible for that repair. If you're renting and there's a problem with a faucet in your home and it's leaking, then you'd contact your landlord and then they would contract a plumber to come and fix it. Once you're a homeowner, a leaky faucet means that you're responsible for reaching out, contracting a plumber, and paying the plumber to come and fix it. It's really important that you create an emergency fund account once you become a homeowner or in the process of becoming a homeowner so that you have money set aside for these repairs as they come up. We've created this move-in checklist for you so that you can be sure that you take care of all these items when moving into your new home. Here's an overview of the mortgage timeline. This is the amount of time that you can expect each portion of the process to take. For example, step 1 is application and processing. You can expect this to take between 7 to 14 days. During this part of the process, it's especially important that you stay in contact with your mortgage loan officer and their processing team and are responsive to any requests for additional information so that we can provide the most complete application to the mortgage lending team. The second part of the mortgage timeline is underwriting. During this 7 to 10 day window, your mortgage loan application, along with the appraisal and any applicable inspections, are reviewed by an underwriter. This underwriter might find any pieces that they feel are higher risk, and then we'll reach back out to you as the applicant for additional information. Once again, it's so important that during this part of the process that you, as the applicant, are responsive to any requests that we have for additional information. It's important that we provide this information in a timely manner to the underwriter so that we can close the transaction on time. Closing on time is the responsibility of both the mortgage loan officer and you as the buyer. So it's especially important that throughout the process that you are on top of your emails and your phone and are responsive to any requests that we might have for you. The final piece of the mortgage timeline is closing. This is typically a 7 to 14 day window of time. During this time, you're going to make sure that you provide that first annual premium of homeowners insurance paid in full and provide that receipt to your mortgage loan officer. In addition to that, you'll want to make sure that you provide any last bits of communication with your realtor and with the seller to coordinate the closing time and location. Most importantly, you want to make sure that on the date of closing that you have a cashier's check for the total amount due, which will encompass both the down payment and the closing costs. If you have any questions during the closing timeline, make sure that you reach out to your mortgage loan officer or the mortgage processing team. They'll get back to you and make sure that you have all the information that you need so that your closing goes smoothly. Thank you so much for submitting your questions. There were a few questions that didn't quite fit into our presentation, but we wanted to make sure that we address these questions and provide you the answers. So we're going to go through a couple of the questions. I'll read the question aloud and then I'll provide you my best explanation. So this question says, I want to know how much I should have saved to buy a house. This is a great question. So how much money that you need saved really depends on the purchase price of the house that you really want to buy. So for example, a more expensive house is going to require a higher down payment in general than a house that costs less money. The amount of money that you are going to need to have saved also will depend on how much the down payment will be, whether it's a 3% down, 5% down, or 3.5% down if you're doing an FHA loan. So it really depends on your unique situation and how much money that you're going to be putting down in the transaction, as well as the closing costs that are associated with that home purchase. One of the other questions that we received is on negotiating the price. What is a successful way to make offers below the asking price? And questions about earnest money, contingencies, and the time to reply strategies, as well as the dollar offer. This is a great question as well. So it's really important that you work with your realtor when deciding how much you're going to offer and then handling those different contingencies and then counter offers. So it really depends on market conditions as well. Currently in 2021, we are in a seller's market, which means that the market conditions are more in favor of sellers at this time, meaning that we're seeing a lot of offers that are even above asking price. In this sort of circumstance, you're maybe not going to be able to negotiate in the same way as when it's a buyer's market. But this is something that your realtor can help guide you through step by step to make sure that you're not paying more for a house than you can afford. So the reason that it's considered a seller's market is based on a variety of factors. One of them is that the inventory, or the amount of homes that are available in this area, are relatively few compared to the amount of buyers that are looking for a home. When there's very few homes available and a lot of buyers that want those same homes, then escalating offers, or one offer from one buyer and then another offer from another buyer, compete, causing the price of the home to increase. So sometimes a buyer will put in an offer above the asking price, hoping to beat out the competition. So one question that we received a lot is, where do I start? This is a completely fair question, and as I said, buying a home can be overwhelming at first. We want to assure you that you can meet with a mortgage loan officer and that we will guide you through every step of the way. There is no stupid question when it comes to buying a home. One question that we receive is, can you meet with a mortgage loan officer even if you're not sure if you're in a place to buy a home? And the answer is absolutely. Many times we meet with potential home buyers because they want to see how far off homeownership is for them. So maybe they don't have that much money saved for the down payment yet, but they want to know how much money they need to save, or if they're even in a place to consider buying a home in a year or 2 years. This is absolutely something that we can help with. By sitting down and seeing where you stand as far as your employment, your income, and the debts that you have currently, we can create a plan for you to make homeownership a reality, whether it be in 6 months, a year, or 2 years. One of the questions that we received was, what is the best mortgage rate and how to determine if you get a decent rate? So interest rates fluctuate depending on market conditions. Also, the interest rate that you qualify for as the buyer will depend on a variety of factors in your application, including your credit score, your debt to income ratio, and then how much money you're putting down for the down payment. All of these factors come together to determine the interest rate that you qualify for. So another question that we received is, if I find a house that I like, but it needs repairs, can the loan amount I take out have some left over so that I can use that for the repairs? This is a great question and one that we receive often. So the answer to that is no. The mortgage loan that you take out is only for the purchase price of the home. You can't take out a mortgage loan for the purchase with an additional amount for home repairs. Now, there's many different grant opportunities, not only for down payment assistance, but also for post-purchase rehab repairs. This is something that you can apply for if you're interested in receiving a grant, depending on your eligibility for those repairs. Another option is, after you take out your mortgage loan and that process is closed, you could apply for a personal loan in order to complete those repairs. But it's really important that you keep in mind that you don't want your financial situation to change drastically in addition to your home ownership purchase. After you buy a home, you're going to be getting used to paying that monthly mortgage payment. So it's important not to add additional debts on top of that. Otherwise, it might feel like too much change for you in your monthly budget. So one of the questions that we received is about issues with credit scores or low credit scores. So most mortgage loans require a credit score of 620 or higher in order to be approved. Now, this depends on a variety of factors. Of course, in addition to your credit score, there's also your debt to income ratio and the amount of money that you're placing as the down payment. However, If your credit score is currently below 620, then there's a variety of things that you can do in order to improve your credit score so that home ownership can become an option for you. It's very important that you don't have any missed payments on any of your current debts. Even if you just have a credit card and you're late on one payment, this can drastically impact your credit score. And in addition, on those credit cards, make sure that you're keeping your balance low compared to the available credit limit. Another way to increase your credit score is to make sure that you don't have any collections hanging out on your credit report. Collections can come from unpaid medical debts or any unpaid bill to any other creditor. So it's important that you keep track of all of your bills, make sure that they're paid on time, and then pay off any collections if they are on your credit report. Thank you so much for your time today to watch this video. If you're interested in applying for grants and want more information, then click the description box below and click on the link for our video on grants. We at Fort Community Credit Union want to see your dreams of home ownership become a reality. So reach out to us anytime and we'll help you along the process to make sure that everything goes smoothly and that your dreams of home ownership come true. Thank you so much.